So, your grocery bill keeps creeping up, home prices feel out of reach, and your credit card interest grows faster than your balance. It all ties back to one thing: interest rates. You see, the Federal Reserve, often just called the Fed, recently made an announcement that inflation is proving to be more stubborn than they expected, and that means interest rates will likely stay higher for longer. Now, I know this might sound like just another headline, but what does it really mean for you, your finances, and your future? That's what we're going to talk about today, explain why this matters, and walk you through how this decision can impact your wallet. And I promise you'll walk away with a much clearer understanding of what's going on and how to handle it. So, let's start with the big picture. The Federal Reserve is basically America's central bank, and one of its main jobs is to manage inflation, how much prices go up over time, while also keeping the economy strong. Now, over the past 2 years, inflation got out of control. Remember when groceries, gas, and rent were climbing so fast it felt like everything cost twice as much? To get that under control, the Fed raised interest rates aggressively, which makes borrowing money more expensive. This includes things like mortgages, car loans, credit card interest, and even personal loans. Higher rates discourage people from spending and borrowing as much, which helps slow inflation. Here's where we are now. Inflation has come down from its peaks, but it's still higher than the Fed's goal of 2%. Recent numbers have been stickier than they expected, meaning prices aren't falling as quickly as hoped. That's why the Fed announced that interest rates will need to stay elevated for longer. It's like keeping the brakes on the economy for a little while longer to make sure inflation doesn't bounce back. Now let's talk about what this means for you. If you're looking to buy a home, for example, this decision could make things tricky. Mortgage rates have already been hovering around 7% or higher, which is way above the 3% rates we saw a few years ago. That means buying the same house now costs a lot more in monthly payments. So if you're waiting for rates to drop before buying, it's likely you'll have to keep waiting. And if you already own a home with a low mortgage rate, this is why you're probably not selling anytime soon. Most homeowners with rates locked in below 4% don't want to trade that for today's higher rates. That's one of the reasons housing inventory is so low right now. Less inventory means prices aren't falling much either, which makes it even harder for buyers to get into the market. But it's not just homeowners. Higher interest rates hit anyone who carries credit card debt. Credit card rates are already sky high. Many are sitting at 25 to 30%. If you're carrying a balance month to month, you're paying a lot of money in interest. That's why now is the time to focus on paying down those balances if you can. Even small extra payments can make a big difference over time. Car loans and personal loans are affected too. If you're looking to finance a new car or take out a loan for a big purchase, you're going to see higher monthly payments. And here's the thing. Banks are also tightening their lending requirements because they're worried about people defaulting on their loans. So not only is borrowing more expensive, but it's harder to qualify for financing in the first place. And for those of you with student loans, this could also have an impact. Private student loans often come with variable rates, which means they move up and down with the Fed's decisions. If you're paying off private loans, you might see those payments continue to climb. Now let's shift to the bigger picture of investing and saving. If you're someone who's been keeping your money in a high-yield savings account or certificates of deposit, or CDs, you've probably been enjoying higher interest rates. That's one of the few silver linings here. Higher Fed rates mean banks are paying better returns to savers. Right now, some savings accounts are offering 4% or more, which we haven't seen in years. That's great for building an emergency fund or parking cash you don't need right away. But here's the thing, if rates stay high for longer, it might not be forever. As the Fed eventually lowers rates in the future, those savings account returns will go down again. So it's something to keep an eye on. And for stock market investors, the situation is more mixed. When interest rates go up or stay high, companies have to spend more money to borrow for growth. That can slow profits, especially for smaller businesses or tech companies that rely on borrowing. This is why the stock market often reacts negatively to news of higher for longer interest rates. If you've been feeling nervous about your investments or retirement accounts, you're not alone. But here's the thing. Historically, markets have always bounced back, even after challenging periods. The key is to stay focused on your long-term goals and not make decisions out of panic. So then, what can you actually do to prepare for this new environment? First, if you have debt, prioritize paying it off. Start with high-interest debt like credit cards, then work your way down. Even small extra payments can help you chip away at those balances faster. Second, if you're saving for something big, like a home, car, or emergency fund, consider locking in today's high interest rates on savings accounts or CDs while they're still available. Third, avoid taking on new, unnecessary debt if you can. This isn't the time to make big purchases you can't comfortably afford. And lastly, if you're investing, stick to a solid plan. Focus on quality investments, diversify, and don't try to time the market. Now, let's be real. This isn't the news many people wanted to hear. Higher interest rates can feel like a weight holding down the economy, making life more expensive for a lot of people. But here's the upside. The Fed's ultimate goal is to bring inflation back under control so that prices stabilize and we don't end up in a cycle where everything just keeps getting more and more expensive. It's a long game, but stability is worth the short-term discomfort. At the end of the day, managing your finances during times like this comes down to making smart, intentional choices. Pay down debt where you can, save where it makes sense, and stay focused on your long-term financial goals. Things might feel uncertain right now, but by staying informed and taking action where you can, you'll set yourself up for success no matter what the economy throws at us. So I hope this breakdown helped give you a clearer understanding of what's going on and why it matters. If you have any questions or thoughts, I'd love to hear them. Leave a comment and let me know how you're feeling about all this. And if you found this helpful, consider sharing it with a friend who might need to hear it too. Thanks for spending this time with me today, and I'll see you next time. Take care.